Good morning to all of you. So we have now covered the entire stretch of PGBP and the entire stretch of capital gain, right? So it's been two important chapters for an intermediate examinations. As far as the examination goes, salary is the most important chapter. And then, of course, you'll have questions from capital gain and house property. As far as PGBP is concerned, we saw a couple of exam-oriented questions which will probably tell you how it is questioned in an examination. As far as PGBP, you will be tested on a very limited scale. So the questions will predominantly be, you will have a profit and loss account where you distinguish each of the heads of the income and then take it forward. So that's what we generally do in PGBP. What is questioned during your examination? Your primary test for PGBP will lie only in your final examination. As far as your intermediate, very basic sections. We did mention certain sections which are very important for your examinations. Apart from that, rest of the things you may know or you may not even know. It is that not that much of importance. So, as far as capital gain is concerned, there are various exemptions, but we only covered 5 exemptions. So, which typically, like we first said, it is for buying a residential house, which is 54 and 54F. Then we saw 54B for agricultural land and 54D for compulsory acquisition of urban agricultural land. And then we also covered 54EC, which is for investments in bonds. So these are the 5 exemptions that will primarily be covered in intermediate. Rest are covered only in your final. So this whatever we have been discussing right now, what we are going to do right now is we will cover questions, questions across the session. What is being questioned in your study material, what is being generally tested in your what you call examination. So we'll discuss all that. So what we will do is we will start with the first question, which is basically your study material question. So when it comes to your study material question, it's question 4 of study material. So what does the question say? It is Mr. A. Mr. A is basically an individual carrying on business. And moment you say you are an intermediate student, you will only be questions on individual HUF. You are not tested on any other person, very rarely on firms, but predominantly only on individuals in HUF. So Mr. A is an individual carrying on business. His stock and machinery were damaged. Stock and machinery were damaged and destroyed. Stock and machinery was damaged and destroyed in a fire accident. The value of stock lost was 6,50,000. As I told you, when you read the question, try to give importance to what is important, what is relevant for solution, what is not relevant. You might have both the things. So we are trying to understand that there is a stock involved, there is a machinery involved. There is a stock involved, there is a machinery involved. So these two are the ones that are damaged and destroyed. So whatever insurance claim that on damage or destroying of a stock, the premium paid is an eligible expenditure when we discussed about PGBP. So when something is damaged or destroyed, we also saw in capital gain, when you receive an insurance receipt, you deviate from the general principle of amount being taxed in the year of transfer. Rather, in case of insurance claims, the amount will be taxed in the year of receipt. So what we are going to discuss about is stock and machinery. When you say stock, it will get covered under what head? It will get covered under PGBP. When you say machinery, we need to see whether it will get covered under capital gain. Okay. The next is the value of stock lost was 6,50,000. So that's related to the stock. So which means it pertains to PGBP. Certain portion of the machinery could be salvaged. So which means it's not an usable condition. The opening balance of the block on 1st April 2022, that is after providing depreciation for previous year 21-22 is 10,80,000. So that is opening balance for previous year 22-23 is 10,80,000, which is after providing depreciation. So that's what they say. They say it's a WDV after providing depreciation. We saw in section 43, the definition of WDV. Your WDV refers opening, add additions, less deletions. Finally, you get WDV. On WDV, you charge depreciation. Then you get the closing WDV. So that closing WDV is carried forward as the opening WDV of next year. So your question only if uses the word after providing depreciation. When it says WDV after providing depreciation, which means depreciation is already provided. Otherwise, if it just says it's the WDV as on 31st March, if this is the word that is used, it generally means that depreciation is yet to be provided. Only if the question says after providing depreciation, it says depreciation has been provided. So that is for the closing WDV. So WDV as on 31st March 2022 may be after depreciation, may not be after depreciation. How do you know? The question will specifically say that depreciation has been provided. Only then it is provided. So that's what it is there. Otherwise, you may still take an assumption that saying that it is already provided, it is okay, but we need to look into it. So the WDV is 10,80,000. During the process of safeguarding machinery and in the firefighting operations, Mr. A lost his gold chain and a diamond ring. Please understand what is lost. Gold chain and a diamond ring. Okay. So that is lost. So now these are personal assets, personal effects. Are they asset or not an asset? We said there are exceptions to personal effects. So what are the exceptions? We said jewelry, a sculpture, a drawing, a painting, or any work of art. These 5 things are an exceptions to the concept of personal effect. So now he has purchased this in 2005 for 1,20,000. The market value on the date of accident is 1,80,000. So this is what is being explained here as far as whatever has been said. Now, it is the fire as accident. The fire is actually accident on previous year, let's say in 22-23. Now what they're saying is they're not giving you any dates, nothing as that. They're only trying to understand the taxability of certain things. The first they say is towards loss of stock. So towards loss of stock, the insurance is providing them 4.8 lakhs. Whereas towards gold chain and towards damage of machinery, insurance provide them 6 lakhs. So they are providing cash of 6 lakhs, claim of 6 lakhs. And the last one is the whatever is the amount that is towards gold chain and diamond ring, they say it is 1.8 lakhs. Okay, so these are the things that say that is being received. Now we need to say what is actually question. It says you're requested to briefly comment. So you only have to write a theoretical answer on what, on the tax treatment, whether this is taxable, not taxable, if taxable, under what head and how much. So just a brief comment as to what, probably what 2 marks per answer or whatever it is will be your value for this particular question. So the first concept is loss of stock. How will you treat it? So what did we study for insurance receipts? We said it is taxable in the year of receipt for capital assets. But now stock is what? Stock is PGBP. So we need to say that this income is from PGBP. This income, whatever we are talking about of stock, is from PGBP. So this PGBP income is taxed in the year, is taxed under the head of business or profession. So what is exactly the value of tax? The value will be 4.8 lakhs. So when you write in the examination, you try to say that this particular transaction, that is the compensation towards stock from the insurance company for the stock loss, is a trading item and hence will be taxed under their profit and gains of business or profession. Hence 4,80,000 of insurance claim of the loss of stock will be treated as an gain, will be treated as an income under that PGBP. So that's the first thing that you need to cover. You can also convey that the value of stock loss could be claimed as loss in the PGBP in the year in which it actually happened. So you're trying to convey that this income is under PGBP, and if there is any value of the stock loss, could be claimed as a loss in your P&L. So that is also there. So whatever it is what this is what you need to convey for this particular thing. What is the second point we are saying? We are saying that towards damage of machinery. So when you say damage of machinery is a capital asset. Machinery is a capital asset, hence it will get taxed under capital gain. Now, when will capital gain arise for a capital asset, we said for depreciable assets, it will be taxed in the year when the block ceases to exist or the sale consideration of that asset exceeds the WDV, right? The net sale consideration exceeds the WDV or the block ceases to exist. These are the two situations where your capital gain will arise for depreciable assets. It will always be short-term loss. And we also saw that only in the case of building, in case of depreciable asset, even if it is a depreciable asset, it could still be called as a long term depending upon the period of holding. So that is only for the building. The rest of the capital assets which undergo depreciation will always have short term capital gain, because you take only the WDV. You are always depreciating it. So whatever you take is only the WDV. So it will be considered as a short term. Now here, what do we say? You say that whatever is taxable. So how much is taxable? 6 lakh is taxable. Whatever the 6 lakh is what is being received from the company. Assuming both this is happening the same year, that is the fire and the insurance claim. If it is happening the same year, the 10.8 lakhs, that is the 10.8 lakhs, which is being treated as, which is your WDV is what it is there. And the balance 6 lakh, whatever you have received will be reduced. So the 4,80,000, which is your balance returned on value, will be treated as capital loss if the entire block of asset has gone. The question does not say whether this machinery is the only machinery or what exactly are they trying to say. So the question is not clear about the block as a whole. So generally what you say is, insurance receipts are taxable in the year of receipt, but this being machinery, being a capital asset, being a depreciable asset, you only need to reduce it from the WDV and you need not recognize capital loss unless the entire block ceases to exist. So we can take an assumption that the entire block ceases to exist. So we can say the question does not provide whether the machinery alone was the entire block, because it only says the certain portion of the machinery could be salvaged. It does not talk about the entire thing, and it also does not talk about whether any new machinery was provided, what exactly has happened. So our assumption could be, assuming that the machinery is the whole block, the machinery block ceases to exist, hence the WDV on the closing value will be treated as a loss. The loss or gain. So now it is 10.8 lakh is your total value of the WDV. 6 lakh is what is being claimed from insurance. So the balance 4.8 lakhs is a short-term capital loss. So how do you arrive? It is 10,80,000 minus 6 lakhs. So is equal to 4,80,000 will be what? Will be short-term capital loss, because you assume the entire block of asset has ceases to exist after this damage. So this is what you need to specify, that assumption, and then say the excess of 4.8 lakhs over, which is 10.8 lakhs minus 6 lakhs, will be treated as short-term capital loss. So that's what it is about. Okay, the third one is towards golden chain and diamond ring. So what exactly is golden chain and diamond ring? We said personal assets are not capital assets except jewelry, sculpture, painting, drawing, work of art. Now all these five is an exemption. So being golden chain and a diamond ring, it is a capital asset, though personal in nature. It will be taxed. The insurance receipt, whatever is being received, will be taxed in the year of receipt, 1.8 lakhs. So this 1.8 lakhs will be treated as capital gain in the year of receipt. However, you may consider, for the example of cost of acquisition, whatever it is there, this might be reduced from the cost of acquisition. So whatever is there, that is 1.2 lakhs, April 2005 is 1.2 lakhs. This must be indexed. So you can say that we need to exclude 1.8, which is market value. Because why should we exclude the market value? Why? Because the asset is purchased after 1st April 2001. So there is no question of market value. You'll have to take the actual cost, index it. So the cost of acquisition is 1.2 lakhs as on 1st April 2005 and not the market value on the date of incident. So this will be indexed. And you get the 1.8 lakhs minus the index cost of acquisition index from 1.2 lakhs will be there. Your question does not provide the CII, the capital indexation for that particular year, that is financial year 2005-6. So you need not do any indexation. It only wants your comment. Please understand the question. Only answer for what is requested. You need not do anything extra. Don't do anything short also. Exactly answer what is required. So the question has not provided CA and all. The question does not want you to calculate the gain also. It only wants you to comment on the taxability. So all you need to do is just say whether that income is taxable. How will the tax be arrived? So how will the tax be arrived? 1.8 lakhs minus index cost of acquisition. That's the only thing that you need to specify. Don't try to remember indexation. It is not at all required. Whoever is trying to remember the table of indexation, please leave that exercise. You need not remember. Maybe you can remember two indexation. I'll tell you can remember two indexation. One is that of 2001-2, which is 100, and then current year 2022-23, which is 331. Nothing else need to remember. Even this I am telling you just for the sake of your efficiency. You might not look at the question paper for that indexation. You will straight away start working if you know these two. But for every other year, do not worry, do not try to remember the indexation. It will be mentioned in the question paper. There will never be a question without mentioning the indexation between these years. Maximum possible scenario is you might have to remember these two, that is financial year 2001-2, which is the base year, which is 100, and the current year 2022-23, which is 331. Only these two you need to remember. I am happy if you have the capacity to remember all the indexation, but you can better use that memory power to remember something else useful rather than remembering the indexation table. So please leave the exercise of remembering the indexation table and answer only what is required in the question paper. So this question requires only comment on taxability. It does not require you to compute the capital gain or compute the taxability. It only requires you to comment on the taxability. So we'll stop it there. So this is what is about this question. Okay. So with this probably even your study material questions, you only have 4 questions in your study material. So all that is already discussed, correct? So as far as your capital gain is concerned. So now we'll move on to the next question. Question 5. Question 5 is typically about your Ram has purchased 1,200 equity share. Ram has purchased 1,200 equity shares, listed shares. Okay, listed shares of 10 each. So this is typically of a company on 15th April 2001 for 78,000. So this is the first thing. Okay, so he has purchased listed equity share at rupees 10. So it is of a company on 15th April for 4,80,000. So 10 each of company on 15th April 2001 for 78,000. So his actual cost is 78,000. Though the face value is 10,000, what he has actually invested is 78,000. Now company declared a rights issue in the ratio of 2:1 at a price of 30 per share. Okay, 30 per share in October 2022. The first purchase is in 2001, and then in October 22, he sold the rights for 300 shares at 20 per share. So now we have sold it for 20 per share for the 300. Please remember what section? Cost of specified assets. How do you identify the cost of specified assets? We discussed about right share and bonus share. For right share, what did we say? We saw three scenarios where first is I myself am buying that right share. First scenario. Second scenario is I am completely rejecting it. I am not buying it or I am not transferring it. I am completely rejecting it. The third situation is I am transferring the rights to someone else. We saw 3 situations. We saw cost for these 3 situations also. For the first thing, it is straightforward. Whatever you paid to the company for the rights becomes your cost. If you are rejecting everything, no cost, nothing, no capital gain at all. The third situation is you are transferring the rights to someone. So the amount you received from that person becomes your capital gain income. But for that person, The cost will be what he has paid to me, what he has paid to me, plus what he has paid to company, correct? So this is the three scenarios we discussed. That's what we are seeing in this question. What are we seeing? 30 per share in October 22. So he has partially accepted, partially rejected. So 2:1, right? So if you say 2:1, he'll be allotted 600 shares. 600 shares. So for every one share, for every two shares, he is receiving one share. So he will receive 600 shares. Now remaining were purchased by him, which are allotted on 5th November. So the allotment date is 5th November 2022. For the period of holding for right share, it is the allotment date, not the date in which rights are actually issued. So he sold all the shares at 90 each. So the entire 1,500 shares, that is 1,200 plus another 300 on 15th March 2023 through a recognized stock exchange. He paid brokerage at 2%. So this is what the question demands, right? So he has initially purchased 1,200 shares. 1,200 shares as far as your listed shares on 15th April 2001. And then he has got a right share in October 22 for 600 shares. Out of 600, he has purchased 300. He has transferred the right to another 300. So that is given here. And then he has sold all the shares at rupees 90 each on 15th March 2023. And they have given for 1-2 and 22-23. As I told you, these two you can remember on your own. You need not even tell, because in practice, when you're repeatedly solving this question, 331 straight away gets into your mind, because in every question here and there you will be applying 331 in capital gain, so it automatically gets into your mind. Same way with 100. Every time when you are using old market value, you will start applying this 100, and moreover this is the base. So these two are straightforward, 100 and 331. So always remember this. Rest of the thing, I don't think it is actually required for you to you need to remember. Okay, so this is what is the question about. Now, how do you determine? So the first thing we need to start is we need to calculate the capital gain, right? So there are three capital gains. One is basically from the rights renounced, that is, he has transferred to someone. Next is the rights that he has taken up, and the third category is basically is the entire sales. So the entire sales, that is this 1,200. So I'll just write a small glimpse here. So one sale is 1,200, which is long term, right? Which is long term, and it's listed equity share. So there is no question of indexation and all. And moreover, the question does not talk about whether the 31st January 2018's market value is actually not provided, right? So it's actually not provided. So what we can do is we can actually take this entire thing, or probably what we'll do is we'll assume a market value. We'll assume the market value on 31st January 18 is 100 per share. Okay. For ease of convenience, let's take the 31st January 2018 value as 100 per share. Now, the first 1,200 is LTCG, taxable under section 112A. The second is 300 given up, right? So that whatever is there, that is income is itself is whatever is receiving, 20 rupees per share, that only is income. This will be your, this has happened only in October 22, and he is finally selling it, entire sale in March 2023. So it is what? More than 1 year or less than 1 year? It is less than 1 year. So this will be short-term capital gain. And then the third one is another 300 shares. This is also short-term capital gain. Under section 111A, correct? 111A. So these are the three things that we need to work on. So as far as your question goes, so what should you do? Now we'll start working out this. We'll say computation of capital gain. Computation of capital gain of Mr. Ram for assessment year 20, 23, 24. So what do you start with? You start with your table, which will have particulars, Then I'll have amount column. If required, I'll use another amount column. So you can always have two amount columns. It may be helpful. And then, as I told you, one reference column. Why is it important? I am repeatedly stressing this point because it is that important. I have told you it is very to the power of n critical, because the nodes will only tell the valuer that you know the provision and you have not just written something randomly. So for that purpose, please make always use of this reference. However silly it is, however stupid is it, please write your assumptions or please write your notes. So it is very important. So these are the three things that you need to do. So first thing, we'll start with the capital gain on the sale of right share, correct? So we'll start with short-term capital gain. We'll start with the short-term capital gain. Okay. So I'll just make a little neat just to tell you, whenever time permits, you can always make these neat lines and all those things is always encouraged. And when you practice more problems, this automatically comes. The spacing, the border, the formatting, everything comes. It will also make up sometimes for your bad handwriting. So when your handwriting is bad, when you have these tables, borders very clearly written, it might give an assumption that your handwriting is better than what you generally think it is. Okay, so we'll start with the first thing. Okay, that is, I'll write it as transfer rights, transfer of right. Okay, so that's the first thing. First thing, what is the sale consideration? Sale consideration is, yes, transfer the rights of 300 shares, right? 300 into, for how much has he transferred? For how much has he transferred? He has transferred it for 20 per share. 20 per share, correct? 20 per share. So 300 into 20. How much is it? 6,000. I'll do one thing. I'll write 6,000 in the inner column so that you can have only the capital gain in the final column. Less cost of acquisition. Okay, cost of acquisition. So what is the cost of acquisition here? The cost of acquisition here is nil because he has not paid anything. He has only given up the rights. So the cost of acquisition is nil. So short-term capital gain is 6,000. Okay. So the short-term capital gain is actually 6,000. Next, the second thing is, yes, rights has been taken away, right? So some of the rights have already been considered for which he is okay. So for that is also short-term capital gain under section 111A. You can also write that, we'll call it as A, okay? And next is rights share. So this right share is basically again sale consideration. So what is sale consideration here? It is short term. So I can actually ignore the market value and all on 2018. So whatever the sale consideration, so whatever is the sale consideration is basically your 90 rupees, right? So whatever the sale consideration is 90. 90 is being what is sold on 15th March 2023. So it is 90 per share. So you take 300 into 90. Okay, 300 into 90. So how much is it? It is 27 inner column. Inner column less cost of acquisition. How much is cost of acquisition? 300 into he paid 30 to the company. He paid 30 to the company. So I'm sorry. So there is one more thing, right? When you say sale consideration, immediately what you need to do is you need to see whether there is any expenses to adjust for net sale consideration. So here we have a concept called brokerage at 2%. So we need to adjust that net sale consideration. So we'll first adjust that net sale consideration. How many of you have started the striking in red color when you're actually doing your exams questions wrongly? It is not for question exam session. It is here for you to get practiced for the examination by trying to strike out so that to tell yourself that you are making a mistake, to see that the number of mistakes keeps reducing when you keep marking it in red. So over a period, when you keep on working, your mistake will start getting to reduced if you start highlighting your own mistakes in a different color. I have been telling this. I'm sure some of you would have started following this. It's definitely a good, very good exercise for problem papers. Okay, so less brokerage at 2%. So 27 2% is 540, right? So this is 26,460. Okay. In this, you less cost of acquisition. How much is it? It is 300 into 30. 30 per share is what he paid to 9,000. So how much becomes? It becomes 17,460, right? So 17,460 will be your income. So now we need to increase it to your long-term capital gain. Okay, so that is short-term capital gain. Short-term capital gain B, correct? So these are the two short-term capital gain, the 6,000 and the 17,460. So you can write it as short-term capital gain A plus B, that is 23,460. Correct. You can even write short-term capital gain under section 111A because it is taxable at 15%. The next is long-term capital gain. Long-term is basically sale of shares, right? Sale of shares. So first is sale consideration. For this, you'll have to write reference note 1. What is the note? You need to arrive at the sale consideration because it has both sale consideration and market value will be arrived using the fair market value. The sale consideration is straightforward, but the cost of acquisition only will be actually derived. So we can write here the note 1 here, or the cost of acquisition also we can write 1. So 3,000 into 90. Correct. So that is 27,000. So this is also same thing. So it's not 3,000, right? It's 1,200. I'll just go and see. Yeah, it is 1,200. So 1,200 listed shares. So 1,000 1,200 into 90. How much it will be? 1,08,000, right? 1,08,000. So this 1,08,000 is the total whatever is being considered. So this 1,08,000, on this 1,08,000 less brokerage at 2%. So how much is it? On 1,08,000 it will be 2,000. 2,160, right? So 2,160. So now I'll just extend this film. So this will give you 1,08,000 minus 2,060 minus 2,160. That is 1,05,840 less cost of acquisition. So here you can actually write note 1 and leave it here. So what is the cost of acquisition? Cost of acquisition is 78,000. That is, for per share it will be 78,000 divided by 1,000. So what we'll do is the cost is 78,000. Correct? The cost is 78,000. Now the lower of, right? Lower of fair market value sale consideration. So how much is fair market value? It is 100 per share. So 100 into 1,200, 1,20,000. How much is sale consideration? 90 per share. So that is 1,08,000. So you take whichever is lower. So your sale consideration become 1,08,000. 1,08,000. So whatever is there, 1,08,000. So this will be your final number. So out of this, whichever is higher. So which is basically 1,08,000. Okay, 1,08,000. So now, since fair market value is much higher than the cost, now what we are doing is we are taking into 1,08,000 as your cost of acquisition. So this is what will be treated as your cost of acquisition because your fair market value is higher than the sale consideration itself. So now what I do is I take 1,08,000. So 1,08,000 1,08,000. So I will book a loss, right? I'll book a loss of whatever it is. So my loss will technically be 2,160. That is nothing but whatever is my this number. So loss will be 2,160. So long term capital loss under section 112A will be 2,160, right? So this is the total numbers as far as it is there. So now what we have done is we have identified the short term for the rights renounced, for the rights transferred, for the rights acquired, and then for the rest of the shares, long term for the rest of the shares. Clear with this number? Okay, I'll answer some of the questions. Kavita, study material questions. There are 4. We have covered 3 questions, if I'm right. We covered 2 in the last class, 1 in this class. Out of 4, we have covered 3. So whatever we are covering now is your past question papers from CA, CWA. So your past questions and then some of the mock test questions, whatever has been questioned in the mock test. Okay, what is recognized stock exchange? See, recognized stock exchange is like probably a very familiar stock exchange basically a stock exchange which is approved by the Indian government to run on in our country. So it's like a stock exchange where shares can be officially listed. So it's like a share market. Okay, so we have Bombay Stock Exchange, we have National Stock Exchange. Apart from that, we have several small stock exchanges also. But the primary two stock exchanges is Bombay Stock Exchange and your what you call your National Stock Exchange. So BSE and NSE are two official recognized stock exchange. So these are stock exchanges where shares can be listed. Recently, you would have seen Nykaa, your Zomato, all being listed, right? Your favorite companies from where you order food, where you order cosmetics is now being listed. So they are listed in a stock exchange. So that stock exchange is typically the most popular is Bombay Stock Exchange and National Stock Exchange. So it's an exchange where shares are officially dealt with. Good. I see that some of you are actually marking in red. Anand, Priyanka. Definitely a good exercise. I'm sure it will be very helpful on a long run. Kavita, how are remaining shares 100? So basically, how is remaining share 300? So I'll just explain it right now. So this total shares. So I'll just. So 1,200 shares. Okay. There is a right issue of 2:1. 2:1, which means for every two share, is given one share. So his total share will be 600. 1,200 divided by 2 equal to 600. Now in the 600, 300, 300. 300 is transfer. Yes, transfer the right. 300 is purchased. So he has purchased that 300. So now this 300, the first 300 is what we used it for this 20 rupees. Okay. The second 300 is what he has sold it for 90 rupees. So that's why we have computed 300 separately. Magima, this is the first time I've joined ICL live classes. I'm happy that you're here in live classes. See, your live classes are also available on recorded classes. So it is always available in your app and YouTube. So what you can do is you can go through the earlier classes and then you will get a complete understanding based on which when you hear this again, you will have a better understanding. So you can always redo that exercise of hearing the whole classes, recorded classes, and then proceed with the live classes. So Priyanka, good. Yeah, it is 1,05,840 will be the net sale consideration. Abdul, indexation is given in this question to only confuse us. Yes, exactly. Because you might think that it's long term, so you might end up applying the indexation. Rather, you being in listed equity share, what you need to do is you need to actually not index it. So it is generally to confuse you. As I told you, certain parts are relevant, certain parts of your problem is not relevant. So you need to see what is relevant for a solution, what is not relevant. Every information might give you some additional value. That additional value, you need to decide whether it is relevant, not relevant. Equity shares bought before 31st January 18 does not need cost of indexation. It's not the date. Listed equity shares does not require indexation. So once before 31st January 18, you'll have to take that market value on 31st January 18. After 31st January 18, nothing needs to be done. Straight away, sale minus purchase cost. So no indexation, nothing. Sale minus cost of acquisition. So indexation is not required for any of the listed equity shares, irrespective of the date of purchase. Vashishta, Pranav Vashishta, the FME on that date is 10 instead of 100. Okay, let's assume you wanted to assume this as 10 per share, correct? So 10 will lead to 12,000. Now, in this case, lower of these two, right? So it will become 12,000. And then your cost will be 78,000. So higher of this. So automatically what you will do is you will take 78,000 into consideration. So you will take 78,000. So assuming the fair market value was 10, assuming in accordance with what Pranav was questioned, if you are assuming that it is 10 rupees per share fair market value, then the cost will become 78,000. So you will book a loss of the difference, 1,05,000 something minus this number. Anand, what do you mean by recognized by SEBI? See, SEBI is what? Security Exchange Board of India. So Security Exchange of Board of India recognizes stock exchange. Only then they are official stock exchanges. Like be it Bharat, say Bombay Stock Exchange or National Stock Exchange, it must be a stock exchange which is recognized by SEBI. If you want me to give a better example for the stock exchanges, just remember companies, okay? Company. When does a company become officially a company? When it is registered under Companies Act. So only when it is registered and approved by the Companies Act. So only when it is registered and approved by the Companies Act, it becomes an official company. Otherwise, it takes some other form. It is not a private limited or a public limited company. So to become a company, what should you do? You should register yourself. You should register yourself in Indian Companies Act, earlier 1956, currently 2013. Only then you become an official company. What do you mean by registration? You apply and the Companies Act authority, the Ministry of Corporate Affairs approve. Ministry of Corporate Affairs approve your company, correct? So this is what is the structure of company. But now take this for stock exchanges. I might have a group of members dealing in shares. Now I will be treated as a stock exchange only when I apply with SEBI and SEBI approves me. So an approved stock exchange by SEBI that is registered under SEBI is the stock exchange which is basically approved. Correct? So I think all of you would have understood the concept of stock exchange, official stock exchange. So this is what it is all about. Anand, yeah. So SEBI is something like a regulator for the capital markets, right? Priyanka, STT was also to be considered. STT is not a expenditure for capital gain. STT cannot be reduced as a expenditure for capital gain. It's not an eligible expenditure for rendering your capital for your capital gain income and all those things. So it is not there. So yeah, Anand, yes. So you apply with SEBI to treat your organization as a stock exchange. Only when SEBI approves, you become a recognized stock exchange. So stock exchange is a group of members becoming recognized by SEBI as an exchange. So that's what it is about. So now we'll move on to the next question. All of you are clear in this, right? So question number 6, where you need to examine the validity, examine the applicability of these capital gains in the following scenarios. That is in 20th December, right? So 20th December 2022, 5,000 shares of ARC Limited. 5,000 shares of ARC Limited is basically that's also a listed company. So again, ARC Limited is a listed company. It is sold by Mr. Kumar at how much? 500 per share and STT was paid at the time of sale of shares. So this sale of shares, whatever we are talking about, is listed in the recognized stock exchange. So he is selling it for 500, and he has also paid STT at the time of sale of shares. These shares are acquired by him on 5th June 2017. So he has acquired the shares on 5th June 2017 at 425 per share by paying STT. So at both the time he has actually paid STT on 31st January. So now what is happening is on 31st January 2018, the shares of ARC Limited was traded in a recognized stock exchange at 450 per share. Now this 450 per share is what your the fair market value on 31st January 2018. So this 31st 2018 is what this basically is the fair market value. So now what should we do? We should first identify what is the sale consideration. So the sale consideration is straightforward, correct? So the sale consideration is 5,000 into 500. So it is what? 2,50,000. There are no brokerage expenses, nothing. So no expenditures needs to be deducted. Directly you need to reduce cost of acquisition. So now to understand cost of acquisition, you need to draw three numbers. You need to arrive at three numbers. What is the first number? The cost. The shares are acquired on 5th of June by 425 shares. So the cost is 425. Next is market value, that is 450. And whatever is sold is 500. So whichever is lower, you take 450. Whichever is higher, you take 450. So 450 per share. So 450 per share will be result in what? 2,25,000, correct? So balance 25,000. 25,000 will be your long-term capital gain under section 112A. Long-term capital gain under section 112A. Right? So that's what it is about. The next thing is, so cost, fair market value, and your sale consideration. So we have taken three. The next question, Mr. Satish is the owner of a residential house which was purchased on 1st July 2015 for 10,50,000. He sold the said house on 14th October 22 for 25 lakhs. 25 lakhs. Valuation as per stamp valuation authority is 45 lakhs. He invested 15 lakhs in rural electric bond. So RECL bond, which is an eligible bond under 54 EC. So now for this, what will be the sale consideration? Sale consideration, to arrive at sale consideration, you should arrive two numbers. One is your fair market value, which is 25, and whatever you have actually sold, whatever is your actually sold, and your stamp duty value. So your stamp duty value is 45 lakhs. You need to see whether it is less than 110%, right? Less than 110%. Here it is not less than 110%. The difference is more than 10%. So the sale consideration becomes the stamp duty value. So you take the stamp duty value as the sale consideration. So stamp duty value becomes your sale consideration less index cost of acquisition, because it's a long term. It is purchased in 2015, so sold in 2022. So it's an index cost of acquisition. So what will be the index cost of acquisition? So LTCG. So what will be the index cost of acquisition? Your cost is 10,50,000 divided by your base year, that is July 15, so 15/16. So 254 into 331. So what will be the number? 10,50,000 divided by 254 into 331. So it is 1368,307. 1368,307. So your 45 lakhs minus 1368,307 will be 1368,307 will be 31,693. Correct? So it only wants you to calculate, examine. As I told you, it only wants you to examine the taxability. So what you need not compute and all you need to do is just comment. So examine you can draw a small table and also explain, because you actually need not calculate the capital gain, but if it's a small table, it's okay. So to save time, you can also say apply index cost of acquisition and calculate the capital gain. So you can do that, or draw a small table and calculate also. Both are okay. See which will be very quick, which will be an easy way to represent. If it is writing in theory alone, it is okay. If you think a small table you are comfortable to put it, you can do that also. But preferably, you only have to tell what is requested in the question. It only wants to examine the taxability. So for the first part, it is taxable under section 112A because it is a listed equity share which has suffered security transaction tax both at the time of purchase and sale. Hence, it will be a long-term calculation under section 112A. So that is what it is. And cost of acquisition will be based on the 31st January 2018's fair market value. Clear? So this is what this problem is all about. Abdul Kavita, yeah, I'm sorry. It is 25 lakhs. Okay, so this will be what? 22 lakh 50,000 and this will be 2 lakh 50,000. And here also, I forgot to include this. I forgot to tell that in this 31, we need to claim 54 EC of 15 lakhs. So your actual long-term capital gain will be 31,693 minus 15 lakhs. That is nothing but 16 lakhs 31,693. Because we need to cover bond. For 54 EC, what should you check? You should check whether it is invested within 6 months. 6 months from the date of transfer. The date of transfer is when? 14th October 2022 is the date of transfer. So November, December, January, February, March, April. So you can invest up to 14th April 2023, but he has already invested in 20th March itself. So it is okay. It is within 6 months. So they are eligible for the 6 month 54 EC. So you can claim this 15 lakh as a demand, and only 16 lakh 31,693 will be taxed as long-term capital gain. Clear? Okay. Mr. Suresh entered into an agreement with Mukesh to sell his residential house. Located at New Delhi on 25th May 2022. I'm sorry, there's one question, so I'll answer that and come back to this question because it's related to the old question, so we'll first cover that. Anand, how do we determine when to use cost of indexation, which is the higher of cost versus FEME and sale consideration per asset? See, typically, it's a question of 112A and 112. Both of these are long term. This is only for equity share. Okay, equity share that is listed in stock exchange, official stock exchange, and then it has suffered security transaction tax twice. That is both at the time of buying and selling. So only if it is a listed stock exchange that has suffered security transaction tax, then it will get covered under 112A. Once it is covered under 112A, we need to calculate the value based on cost, FMV, and sale consideration. Whichever is lower, whichever is higher. Correct? So this is only for listed equity shares and equity oriented mutual fund and trust. I said trust and mutual fund will not be covered under your intermediate. It will only be covered under your final. So what will be generally question is listed equity share. So for that, this is how you do. That is, you determine. If not, if it is 112, other assets other than listed equity covered under 112A, you will take index cost of acquisition. So index it. So you need to index. If it falls under 112, you need to calculate fair market value alone if it is falling under 112A. And this fair market value also, this concept also is only if purchased till 31st January 2018. Only then this comes into picture. If it is after 31st January 2018, no indexation also. Straight away, you need to only take sale of sale consideration minus cost of acquisition. Nothing else needs to be done. So this is how you differentiate between whether you need to index or not. 112A falling under 112A, the listed equity share falling under section 112A never needs indexation, never needs indexation. It is only for 112. Okay. Okay. So now we will come back to question 7 and answer rest of the whatever is there after question 7. So Mr. Suresh has entered into an agreement with Mr. Mukesh to sell his residential house. So it is never 112A, right? It is never 112A. So residential house located at New Delhi. Does the location matter? Location matters only for things like your house rent allowance and other things. For capital gain, location doesn't matter. Only for agriculture land, you need to know whether it is rural or urban. Otherwise, location does not matter for capital gain. So this is given but not relevant. So on 25th May 2022, for 80 lakhs. So the sale consideration is 80 lakhs. Okay. Mr. Mukesh was handed over the possession of the property on 15th December 2022. So it was already done on 15th December 2022, and the registration process was already computed. The registration process of this particular thing was only completed on 14th February 2023. So there are multiple dates given. So what exactly are the dates given? The dates includes over the possession, 15th December is one, that is possession of the property. Possession of the property is one. And then for registration is happening on 14th February 2023. So there are two things. That is discussed under this date. So Mukesh has paid the sale proceeds. They're also giving you what is the sale proceeds, typically the sale proceeds of this. So what exactly is the sale proceeds? The sale proceeds is 25%. The sale proceeds is 25% through bank account. 25% through bank account. Then 50% on the date of possession. 50% on the date of possession. Then balance after completion of the registration. So now the question gives you so many confusing things. It gives you 3 dates. Basically, it says on 25th May, they have entered into an agreement. Then 15th December, they have entered into possession. Then finally on 14th February, they are entering into what? They are entering into the final thing. The final registration on 14th February is happening. Now they give you 3 different payment methods. 25% at the time of agreement, and 50% at the time of possession, and then 50% at the time of possession, and then the balance at the time of, probably the balance 25% at the time of. So that is also given. Now the value determined the stamp value authority on 25th May. What is 25th May? The date of agreement is 92 lakhs, whereas on 14th February 2023 is 94 lakh 50,000. 94 lakh 50,000. So they have given couple of rates, 90, 92 and 94 lakh 50,000. Now Suresh has acquired the property on 1st April 2001 for 21 lakhs. After recovering the sale proceeds from Mukesh, he purchased another residential house property in Kanpur for 22,000. So he has purchased another house property for 22 lakhs. So now they have given your capital indexation for 2 years. They wanted to compute the capital gain for Suresh for assessment year 23-24. So now, as I told you, there are so many confusing elements. We need to see what is relevant and what is not relevant. We'll start the question and discuss. At the time of discussion, I'll tell you what is relevant and what is not relevant. So we'll start with this is the 8th question or 7th. 7. So 7 is compute capital. It's actually computation of capital gain of Mr. Suresh for assessment year 2023-24. Okay. So I'll have particulars. I'll have an amount column. If required, I can always have another amount column, and then the most important, v to the power of n critical, your reference column. So now we work out. So we draw margins to make sure, however poor your handwriting is, you try to make it up with through clear formattings. So by practice, all this will come in no time. You will be able to do at a very ease. Okay. So now this is what it is about. So this, whatever we have drawn now, now we'll try to understand what we need to start with. So we need to start with what? A sold a residential house. So we need to understand sale consideration. We can write the skeleton first. So the sale consideration, is it talk anything about your expenses on sale consideration? I don't think question talks about any expenditure on sale consideration. So they've just taken it, and then there is an index cost of acquisition. So there is no thing. So we'll just say less cost of acquisition, and then you get what? You get the capital gain. So we'll again less exemption is there. We'll go back to understand what exemption he has. He is purchasing another residential house property. He already is selling residential house property. So he is selling one, he is buying one. So he could claim either under section 54, he could claim exemption under section 54, because in 54 only you sell a residential property and buy a residential property. In 54F, you sell any other asset and buy a residential property. So now we'll consider under section 54. So exemption under section 54. Now you will get long-term capital gain. Long-term capital gain under section 112, correct? So this is what will be your long-term capital gain. So this is long-term capital gain under section 112. So now we need to have a note for sale consideration. We can also have a note for cost of acquisition, or because it's indexed, right? Index cost of acquisition. So the word is index cost of acquisition. If you want, we can have a note for this also. Now we'll go and understand the note. So we'll start with note 1. So we'll just stop this with here. And then start with note. So we'll leave it here. Note 1. So note 1 is sale consideration. Why do we need a note for this? Because there are several dates, several things. So first, probably we can write a brief note on section 50C. So 50C says sale consideration will be considered, the stamp duty value will be considered as the stamp duty value shall be considered as so we can write under section 50C, the stamp duty value shall be considered as sale consideration if the stamp duty value exceeds 110% of consideration. Correct? So if it exceeds 110% of the actual consideration, then stamp duty value will be exceeded. So this is the first thing. Then we need to know what stamp duty value should be considered. Is it the date of agreement or date of registration? So what does the provision says? So the provision says in case where date of agreement is different from date of registration. So when the dates are different, when the date of agreement is different from the date of registration, then the stamp duty value on date of agreement will be considered if some part of the actual consideration is paid by, we can straight away say account paycheck, because this says the question talks only about account paycheck, paid by account pay check, or let's say prescribed electronic modes, or prescribed electronic modes. Correct? So this is what is important. This is what is there. So if this SDV on the date of agreement will be considered if some part of the actual consideration is paid by account pay check. So here now, to arrive at your consideration, so full value consideration. So we need to arrive that stamp duty value on what date? We need to take the date of registration, date of agreement. So date of agreement is 25th May 2022. It is 92 lakhs. So on 25th May 2022, that is 92 lakhs, right? 92 only. Then actual consideration, how much is it? 80 lakhs. So now you write this both. Now you know it is more. So considering the STV exceeds 110% of actual sale consideration, the SDV of 92 lakhs will be the full value consideration. Full value consideration, right? So now I go and fill 92 lakhs here. Now we have to come to the cost of acquisition. So the second is cost of acquisition. So 2 is index cost of acquisition. You can write being long term, being building held for more than 24 months. The cost of acquisition shall be index cost of acquisition. So how will you compute? You take the actual cost The actual cost is how much? 21 lakhs. So 21 lakhs divided by 100 into 331. So what will be the number? 21 lakhs divided by 100 into 331. So that is 69 lakh 51,000. So go back here. 69 lakh 51,000. So what will be the this 92 lakhs 92 lakhs minus 69 51 lakhs 69 lakh 51,000. So it is 22 lakh 49,000. So what is the investment in 54? The investment in 54 is 22 lakhs. Okay, investment in residential houses 22 lakhs. So 22 lakhs. So his long-term capital gain is 49,000. So he will be investing as 49,000. So this 49,000 will be considered as. So if you want, what he can do, he has to, this long-term capital gain will be taxed at 20%. This 49,000 will be taxed at 20%. So this is what exercise 7 is. So now we'll see any questions or who have participated in exercise 7. Uh, I think I've explained. Okay. Yeah. Some of you have answered Partha Sarthi, Anand. Yeah. Right. So we all have arrived at the straight number. So I think you all have understood, right? Because I see very less questions. So as I've told you, when you get less questions in the question forum, it means two things. Either I've been explaining it very clearly that none of you have any doubt on that. Otherwise, it's like you're not at all understanding anything. So you're completely blank on what exactly is being done here. So I assume, and I hope that it is because you are all very clear as far as what I have explained till now. So with that, what we'll do is we'll take a short break, okay? 10-minute break, 10 minutes break, and then we will continue after the short break. So see you after the break. Thank you. Yeah. So welcome back. So we'll continue with our rest of the questions. Okay. So we have said that we'll be discussing about various questions right now. So what we'll continue with the question 8. So we'll continue with the next question, that is question 8. So basically, this is about, he is an agriculturist. A is an agriculturist. He has been using his agriculture land for the last 2.5 years. So he has been using it for the last 2.5 years. So which means it's an eligible land for agriculture purposes. Such land was acquired by him by way of will from his father. So he has got this land through will in 2012. The father in turn inherited land from his father. So 2002-3. So the grandfather of A had acquired the agriculture land in 1978 for 3 lakhs. So whatever the cost of acquisition will be the grandfather's cost only. Since it is before 2001, we'll have to take the market value on the land of 1st April 2001 or 18 lakhs. However, the stamp duty value was 20 lakhs. Whenever you say the fair market value, for 2001, there has been several situations where the fair market value, if it is lower than the stamp duty value, what should be considered as the stamp duty value? That is, for a building for 1st April 2001, ideally you need to consider the stamp duty value if it is higher than the fair market value. So that's what it's about. Okay. So now in this, the fair market value is 18 and the stamp duty value is 20 lakhs. The above agricultural land was acquired by the government by issue of notification. Now we come to a situation where it is acquired by the government by 16th April 2016. So what does that mean? So what does it mean is, basically it is acquired, that is, it is compulsory acquisition. So once it is compulsory acquisition, it means that it is an urban agricultural land, and it means that it is exempt. It is exempt under section 1037. So then a compensation was fixed at 15 lakhs, which he received. He purchased an agriculture land on 25th April 22. Rural agriculture land, it's not at all a capital asset. A was not satisfied with the compensation and as such filed a suit in the court. The court, by its judgment on 29th June 2023, received a compensation of another 2 lakhs. So in total, he has received 17 lakhs, which was received on 4th April, out of which he deposited 1,50,000 in the capital gain account scheme for the purpose of agriculture land on 16th August. The rural agriculture land was again sold on 15th September 2023 for 5 lakhs. So now he wants to compute the capital gain for various situations. The first concept is 1037. So in accordance to 1037, an urban agriculture land is not a capital asset. It's not a capital asset, which means it's exempt. So whatever gain you're receiving is exempt. So this entire 15 lakhs, including this enhanced compensation of 2 lakh, so is exempt. So this 15 plus 2 lakh is exempt. And the subsequent rural agriculture land, which is sold in for 5 lakhs in September 23, is not an asset. So not capital asset. So this is what we need to specify. So probably we'll write only a theory. We'll say, in accordance with section 10, clause 37, a consideration for consideration or enhanced compensation or enhanced compensation on compulsory acquisition of urban agriculture land is not taxable under section 10, is exempt under section 10, clause 37. Further, the sale of rural agriculture land on 15 September 2023 will not be considered, as rural agriculture land is not a capital asset, is not a capital asset under section 2, clause 14. So that is question 8. Okay. Satya Lakshmi Sai Kumar, can you explain MCQ case scenario which combination of capital gain and house property trick to solve, fast to solve? See, if a question has both house property and capital gain, probably it will be a case scenario, right? So I think that's what you're referring. So these days MCQs are provided like a case scenario. You're given a story, and then you're given the 5 multiple choice questions based on that case scenario. So if you ask me, as far as this case scenario is concerned, my suggestion would be take your time in actually understanding. When I say take your time, it's not your own time. Try to immediately understand the key points. Key points. For example, MCQ question will be try understanding the what you call the actual income. If it's a property, the income from house property. And when you say house property, you need to immediately, when you read the income, consider 70% alone, because that is only taxed. Whatever loan or something is there, maximum eligibility. Know the rules. Immediate things that you need to remember in house properties. 70% will be considered as the income. Interest up to 2 lakhs. Interest up to 2 lakhs will be considered. So interest up to 2 lakhs, right? So self-occupied interest up to 2 lakhs. And capital gain. So capital gain, as you know, LTCG, STCG. If it's indexation, of course, you need to do the indexation. Otherwise, I think mostly in MCQs, you might be restricted only to probably STCG. So you need to do. So I don't think there is any shortcut to this kind of case scenario. So for case scenario, my suggestion would be understand the key points. Whenever there is a question, understand the key points which is relevant for your solution. So go through the question, try to pick up it from the question. Understand the case as such, come to the MCQ. For each MCQ, refer back to your question and immediately try referring it. So I think probably like in 10 minutes or something, you'll be able to solve the 5 MCQs is my general understanding. So there is no shortcut or something. Just that first step is to understand the situation. Then come to each question, go back to your in each MCQ, go back to your scenario, try to pick up the relevant thing and sort it out. As I told you, one thing that you need to keep in mind is you might end up with any of the answer, A, B, C, D. All 4 will have a method. All 4 will have a number to solve, will have an answer. So anything will look like a correct answer. So you should know the exact portion and solve it. Only then you will be able to get the exact answer. So for MCQs, based on case scenario, please understand the question as such, read the scenario, go to your MCQs, revert back for every MCQ, go back to your question and start solving it. Maximum take 10 questions. It will only help you by solving more questions as such. So I think you need to remember the key provisions to solve the MCQs. Okay. We'll move on to case 9, so question 9. XYZ are three brothers holding certain shares of A Limited. So from the following particulars, compute capital gain and business income of XYZ. So they need to understand the capital gain of and the business income of 3 brothers. So what is the situation? X has acquired 10,000 shares from his father by way of gift on 1st July 2003. So he is hold on to it when the market value was 6 lakh. The father acquired these shares for 1979 for 1 lakh. The market value of these shares on 1st April 2001 is 6,25,000. So typically, what is happening? There is a share which is acquired from the father at a date prior to after 2001. So 2001, 1970. The cost of acquisition is that of the father. That is 1979 is 1 lakh. So you take the fair market value, which is 6,25,000. X began to deal in shares. So he is entering into business. What business? Shares. So he is converting his capital asset into stock in trade, converting it into stock in trade. So this conversion, what does capital gain says? Conversion of capital gain into stock in trade will be recognized as capital gain in the year of final sale of that stock. Final sale of stock. We discussed all those capital gain exceptions where it will be taxed in the year of receipt. We discussed why. So capital gain to stock in trade, why is it finally taxed when the stock is sold? Because at the time of transfer, you don't have cash. You don't have cash to treat it as a transfer. You can't pay the taxes. So the income tax gives you a relaxation. Wait till you finally sell it. So your business income share will be treated as PGBP, rest will be treated as capital gain. So now he is converting into the stocks into stock in trade and credited his capital account with the books of 20 lakh. So he is treating in his books of account the value as 20 lakh. So now, and the market value of these shares on 1st September is only 20 lakhs. So whatever he has capitalized is 1st September. So that is the market value. The market value becomes the cost of acquisition for stock in trade, becomes the sale consideration for capital gain. So the market value for conversion is important because the fair market value becomes the cost of acquisition, the purchase cost for business or profession, and sale consideration for purpose of capital gain. So then, as he does not own any house, he invested 10 lakhs out of his proceeds into residential house property on 30th April 2023. So he is finally selling it on 25th March 2023. Okay. So the relevant year is the first year in which it was purchased, that is financial year 1-2. This is the base year because father's share. So father's year is the base year. Then conversion year is important. Is conversion it on FY 22-23. He is also selling it on financial year 22-23. He is purchasing another property. in 30th April 23. So that is financial year 23-24. So we have data for financial year 1-2. We have data for financial year 22-23. We also hear that he has invested in financial year 23-24. So that is for exemption purpose. So now we'll saw each one independently. We'll start with X. So this is what, 9A, right? 9A. Capital gain of Mr. X for AY 2023-24. So particulars, amount, reference. Okay. So we have all the amount columns. Okay. So now we'll start with sale consideration. So we'll start with capital. There are two heads of income, right? PGBP and capital gain. So we'll start with the first head. First head comes PGBP. So sale. So sale is what is important. So sale is finally sold for 22 lakhs, correct? 22 lakhs. So he is selling it for 22 lakhs less purchase cost. Purchase cost, you have to write a note. You have to write a note saying that it will be considered whatever is the market value on the date of conversion. The fair market value on the date of conversion will be treated as the purchase cost for the purpose of business or profession. So what was the market value at the time of conversion? It is 20 lakhs, right? It is 20 lakhs. That is September 2022. So 20 lakhs. So two lakhs is your business or profession, correct? So profit and gains from business is 2 lakhs. So now you move on to capital gain. You move on to the capital gain. For capital gain, we need to understand that is, again, here also we need to understand sale consideration. So sale consideration, the same note will apply. The same note one will apply because the sale consideration will be the fair market value on the date of conversion. So that becomes the cost in, for business, becomes the purchase value for this purchase, becomes the sale consideration for capital gain. So how much is it? It is 20 lakhs. Now, it doesn't say it is listed. It doesn't talk about anything and all. So probably we'll have to assume that it is unlisted. So whatever it is, we can assume it as unlisted. Since it doesn't talk about anything about STT, it doesn't talk about stock exchange. There's no words, right? It just gives an indication it's a public limited, but that doesn't mean it is a listed entity. It's a registered stock exchange. So your question has to specifically state about STT and registered stock exchange. So now what happens is this sale consideration is 20 lakh less. So since it is not under 112A, it falls under section 112. So index cost of acquisition. Index cost of acquisition. You can do this as note 2, or you can come back and write here itself. Anything is fine. So we'll probably do it here itself. So what is the actual cost? Father's cost. Father's cost was before 2001. So we need to take the market value, which is 6,25,000. 6,25,000 divided by 100 into 331. 6,25,000 into 331. So that is 20,68,750, correct? So his loss will be 20,68,750. Now what is happening is index cost of acquisition 6,25,000 divided by 100 into 3 times 20,68,750. So his loss is 68,750. So he's made a loss of 68,750. So we can say that it's a long-term capital loss. Okay. So with that, what happens? You are done with for X. So there's nothing else that you need to do it for X. All you need to do is capital this. So now it says he has invested in another property on 30th April. Since it's a loss, he cannot claim. Assuming it's not a loss, you have to claim. You can claim exemption. What exemption is possible in this case? He's selling shares. And purchasing a residential house. What section? Section applicable would have been 54F. In 54F, it is a proportion. The sale consideration, the capital gain divided by net sale consideration into the cost of the new asset. In that proportion, you would have given 54F. So that's what it is about for this particular situation. So now 68,750, you will claim whatever 54F and leave it. Since it's lost, there is no 54F and all. So you leave it as it is. Okay. So with that, we are done with X working. So we have completed working for X. So working for X is done. Now we'll move on to the next brother Y. So we'll move on to the next brother, that is Y. Okay. So what is it for Y? Y has purchased 10,000 shares. Y has purchased 10,000 shares from his father on 15th January 2003. So he has purchased in 2003 at 80 per share. He is paying and buying. It's not coming with gift and all. He is paying 80 rupees per share. He also started dealing in shares on 15th June 2012. So he has started his business. The market value of these shares on 15th June was 20 lakhs. 50% of shares were sold by A on 30th March for 12 lakhs. 50% is sold, out of which he deposited a sum of 3,60,000 under capital gain account scheme on 16th July 2023 for purchase of his first residential house. Remember the word first residential house, because it is a thing. Because for 54F to claim, it must be his first residential house. Other than this particular house, he can only have one. So now, since being first, which means he doesn't have any other residential house apart from the one that he is buying. So he is perfectly eligible for section 54F. Very small word. See the word first residential house. What if the question says second residential house? It is still okay. If it says third residential house, 54F is not eligible. So it's a single word, might change the solution entirely. So please give importance to each of the word. Pick what is relevant, leave out what is not relevant. So we'll now solve for y. So capital gain of Mr. Y. In fact, it's not capital gain, right? We'll use the word income, because we are also calculating business. So we'll say computation of PGBP and capital gain. Of course, you have to write it in full. Assessment year 23-24. So again, we'll have particulars. Amount, reference. So as I told you, here you will have to write reference as sale consideration. So we will start with So we'll start with the first thing of PGBP. As I told you, the first head that appears is PGBP. Go by the order of the head in which it has to be reported. The first is sale value. He is only selling half. Please remember, capital gain must be recognized to the extent it is finally sold. So your capital gain, only half of capital gain you will be reporting, because the question says X has sold only 50% of the shares, which means capital gain also will be recognized only 50%, will not be recognized beyond that. Now, Y purchased 10,000 shares from his father on 15th January. So we are going to take business related information for which he is selling 12 lakhs. So sale value is 12 lakhs, which is 50% sold. Now the next thing that he is telling is less purchase cost. As I told you, you need to write a note saying that the fair market value, it is on 15th June 2012, the fair market value is 20 lakhs, correct? So which means 50% of it, 10 lakhs. All this must be covered in the note. So how much is it? 2 lakhs. So 2 lakh is profit and gains from business. Okay. Next is sale consideration. Sale consideration is also note 1, 10 lakhs. You only consider half of it. Less It doesn't talk about anything. So index cost of acquisition. Index cost of acquisition. So what does it say? The market value of these shares on 15th June 2012, when it is actually purchased from father business. But when it is actually converted, he is only purchased at 80 per share for 10,000 shares. So 80 into 10,000 is 8 lakhs. So 8 lakh is in 2003, correct? 8 lakh is in 2003. And then it is about, okay, I think I forgot to note down the indexation value. I'll just look at it. So it is, but please ensure that it will be specified in the question. It will not be like me who was missed out it. So your question paper will have the indexation value, no doubt about it. So 2003 is 80 per share. So whatever it is, your capital gain, whatever you are talking about is, we need to calculate. So for that year, it will be 80 per share. Okay. So 8 lakhs. So 8 lakhs divided by, I'll just see what is the capital indexation for 2003-4. It is, okay, it is 105. It is 105. I'm actually sorry, I've done a mistake here. Indexation must be done only till the year of conversion, not 331. So the year of conversion is what? The year of conversion here is into business was, okay. Here there is no problem. Here we have to convert it only till the year of conversion. So it will be 4 lakhs divided by 2003, that is January 2003, that is 2002-3's year, that is 105, if I'm right. Yeah, it is 105 for 2002-3. And the year in which he has commenced business, is in 2012, that is 2012-13. The period for that is 200. So into 200, we are only taking 4 lakhs because it is half of it. 8 lakhs is the total cost. We are taking 4 lakhs. So this 4 lakhs, whatever is there, is what it is about. Now this 4 lakh is taken into, but he's only purchased, right? He's only purchased. So whatever is converted here till the time of transfer, only we need to index. We should not index it till the sale. We should index it only till the time of transfer. Transfer has happened in June 2012. So we are indexing only till 2012. So this will be the number. So 4 lakhs divided by 105 into 200. So it is 7 lakh 61,905. So this will give you how much? 10 lakhs minus 761,905. So that is 2,38,95. So less exemption. Yes. Invested in capital gain account scheme, right? He has invested in capital gain account scheme. That is exemption. Since he has invested it in capital gain account scheme, the entire amount will actually be eligible as 54F. So exemption under section 54F. So what has he done? He has invested this amount. So he has deposited 3,60,000 under capital gain account scheme. So this 3,60,000 is not entirely eligible, only to the extent what? So 3,60,000 divided by the net sale consideration. That is 10 lakhs into this 238,095. So 238,095. So what does happen? 3,60,000 divided by 10 lakhs correct, 10 lakhs into 238,095. That is 85,714. So this only becomes your long-term capital gain. So 238 minus 85,714. That is 1,52,381. So 1,52,381 is considered. So this is what it is about for long-term capital gain for Y. So Y has made a long-term capital gain of 1,52,381. So the point here is, the important point that we have discussed here is this conversion, the indexation. The indexation for a business sale, the time in which stock in trade is finally sold, the indexation should be stopped till the year it was converted. So the year of conversion in this case is financial year 2012-13. So you only do it till then, you don't do it later on. So that's what it is about. So now we'll see about the next brother, Izzat. Izzat acquired 10,000 by will. So it's a gift, 11th April 2022. So this year only is getting it. The father had acquired these shares in 2005-6 for a sum of 4 lakhs. So it is from a recognized stock exchange, and paid STT. The market value on 11th April 22, that is the date he got it, was 6 lakhs. These shares were sold by Izzat on 29th March 2023. So it's a straightforward 112A computation. So we'll calculate computation of capital gain of Mr. Z for assessment year 2023-24. So here it is straightforward. So I will do particulars. I will have amount. I will have reference. Okay. I will have only one amount column because I don't think there is much required. So we'll just stop with one column alone. Okay, so we'll stop with we'll start with sale consideration. So what is sale consideration? Is finally sold it for 8 lakhs. These lakh were sold on 8 lakhs. Now we need to, since it is before, since the base acquisition was before 1st February 2018, that is the father's acquisition is what is relevant. So we need to identify the market value. So what will be the market value now? The father's, we need to have 3 numbers, correct? So we said we need to have 3 numbers. So let's say there's 3 numbers. That is, you need to have cost. You need to know what is fair market value. You need to know the sale consideration. So the cost is what is father's cost. That is 4 lakhs. That is in 5-6. Father purchased it for 4 lakhs. So the cost is 4 lakhs. Fair market value is 6,90,000. How much is it sold? It is sold for 8 lakhs. So whichever is lower, 690. Whichever is higher, 690. So I take my sale consideration will remain 8 lakhs less cost of acquisition. So this only I'll quote it as 1. I may not write it here. So it is 6,90,000. So my long-term capital gain under section 112A will be $1,10,000. Clear? So my long-term capital gain will be 1,10,000. Clear? So this is the computation for three brothers X, Y, Z. Since the for each of the three brothers, there are three different scenarios: business and your regular income. Clear? So we'll see if there are any questions on 9. Yeah. Renu Kumari Singh, he has invested in July 2023. The question says he has invested in 16th July 2023. The provision for deposit capital in account scheme is you should deposit before filing a return of income or due date of filing a return of income, whichever is earlier. So the due date of filing a return of income is generally 31st July for individuals. Since he has paid into the capital in account scheme before the 31st July, we are taking it. So even if it is in July 23, it is before due date of filing return of income. Hence, we are considering it. So the criteria for capital in account scheme is the amount must be deposited into capital in account scheme before filing return of income or due date of return filing return of income, whichever is earlier. So the concept is, let's say due date is 31st July, okay, of that particular year. And now the filing date, let's say he's filing it on 31st May, then this date is relevant. So this date is relevant in case if he's filing it late, let's say he's filing it on 31st August, then this date is relevant. Because it is whichever is earlier. Maximum time you have for investment is your filing date or this date, whichever is earlier. So that's what the provision is. That's why we are considering 54F, even if it is after April, after the financial year. Okay, next question. The R sold his car for 90,000 on 16th April 2022. So he is selling a car. It was purchased by him on 15th April 2001 for 1 lakh. So that's a car. He spent 25,000 by way of capital repair in 2007. He had applied for 5,000 shares of, so that's one thing. Okay. So with this, there's a stop. He had applied for 5,000 shares of X Limited and paid 5 per share at the time of application. These shares were allotted to him on 16th July 2022, but it was subsequently forfeited on 15th December 2022 as he failed to pay the call money. So whatever he has paid is gone as of that. He holds 5,000 listed shares of Y Limited, which he sold on 29 September 2022 for 220 per share and paid a brokerage of 4,000 per share. 4,000. Shares were not sold through recognized stock exchange. Out of the 5,000 shares sold by him, 2,500 was purchased on 18th January for 1,76,000. He has paid a brokerage of 2,000. The balance bonus shares which are allotted to him on 15th October 2021. So he has got balance as bonus. He is not a dealer in shares. And the car was for personal use. He invested 2 lakhs on 28 February 22 in bonds. I think I put in binds. It's bonds. Bonds issued by NHAI for a period of 5 years. So this is what it is about. I think here also I forgot to mention the rates, the indexation rate. I've repeatedly doing this. So I'm sorry for that. But as I told you, it is pretty sure that your question paper will have the indexation chart. It will not miss out at all. Even if it is missed out, you can check with your valuer. It will be there in your question paper and there's no chance that it will be missed out. So basically, the first thing is about car. So it is a personal asset. So which means it is not a capital asset. Personal asset exception, jewelry, art, work of art, drawing, sculpture, painting. Car is not listed there. So car is not a personal asset. So whatever he has done to the car, that is from this line till this line till this line is what is irrelevant because it is not a required thing. Now, the first thing, there are two things. So we have ignored car. Okay. The next thing is forfeiture. So there is a forfeiture. So which means a share did not go through. So that needs to be considered as capital gain. And then finally, share sale. Okay. Share sale is two. One is regular, another is bonus share. So there are two shares which is being there. So bonus shares are issued out of the 5,000 shares, 2,500 are purchased in 2006 and balance 1,76,000. And the balance was actually allotted to him by way of bonus on 15th October 2021. And when is he actually selling it? He's selling it on 28th February 2023. No, he actually sold it on when? 29th September 2022. Okay. So the bonus was issued on 15th October 2021, but he is actually selling it on 29th September, which is less than a year. So it becomes a short-term capital gain. So bonus becomes a short-term capital gain, regular becomes a long-term capital gain. So now we have decrypted the entire question. Now we are ready to solve the question. So we'll start with computation of capital gain of Mr. R for assessment year 2023-24. Particulars, amount, reference. Okay. So now you take this. So you have two amount columns and one reference column. Okay. Okay. So the first thing is sale of car. Noted in reference on, write your explanation saying that as per section 2 clause 14, personal assets are not capital assets. Since car is a personal asset, it will not be treated as a capital asset, hence capital gain will not arise. So that is for sale of car. So that is note 1. Then you come to the second thing, that is your forfeiture. So now for forfeiture, forfeiture of shares. For this, sale will be sale consideration. There is no sale consideration because he's not selling it, right? So the sale consideration will be nil less cost of acquisition. So this cost of acquisition is basically whatever he has paid. He has paid how much? 5 per share. So this 5 per share, whatever is being paid, will be considered 5 per share for how many shares? 5,000 shares. So 5 into 5,000. So that is 25,000 will be a short-term capital loss. So that is 25,000. Okay. Next, we said we'll deal with the sales. Out of that, bonus is short-term capital. So we'll start with the bonus. So bonus. So sale consideration. Sale consideration. So what exactly is the sale consideration? Is 220 per share, right? So he has sold the entire 220 shares for 5,000 shares for 220. Out of that, regular is 2,500 shares, bonus is 2,500 shares. So for 2,500 into 220. So 2,500 into 220. So that is 5,50,000 less cost of acquisition. We'll have to write a note saying there will be no cost. There will be no cost on that 5,50,000. So the entire bonus shares will be treated. But what? There is a brokerage of 4,000, right? There is a brokerage of 4,000. So we need to include that. I'm sorry. So less brokerage, 50% of 4,000. So that is what? 2,000. 5,48,000. So less cost of acquisition 5 lakh nil. So your total this will be capital gain will be 5,48,000. So your short term capital gain will be 5,48,000 for these shares, for this shares. Clear? Next, it continues, right? Because there is one more part that we need to write. So what we'll do is we'll again write particulars, reference, amount. Okay. So for this balance shares, for this 2,500 shares, again you write sale consideration. That is 2,500 shares into 220. Same as this. So that is 5,50,000. Less brokerage. 50% of 4,000. That is 2,000. So you get it as your net sale consideration. Your net sale consideration is 5,48,000. So your net sale consideration is 5,48,000. On this, 5,000 shares are purchased on 4,000. Shares were not sold to the against out of 5,000 shares. 2,500 were purchased for 1,76,000, for which he has paid brokerage of 2,000. So the cost is basically less index, right? Index cost of acquisition. Index cost. So you take 1,78,000. This is nothing but 176 plus 2,000. So that's how you get this 1,75,000 into he's selling it in 2023, so it is 331. We all know that he has purchased this in 2006. So 2005-6 financial years indexation is 117. So into 331 divided by 117. So 1,78,000 divided by 117 into 331. So 5,03,573. Okay. So your 5,48,000 minus. So it is 44,427. Correct. So 44,427 is there. He has invested in bonds for 5 years. He has invested when 28th February 2023. So what is the period of basically whatever is made, that is 2022, September 2022. So October, November, December, January, February, March. He has to invest it before 28th March 2023. He has already invested in 28th February 2023. So this 2 lakh less 54 EC exemption of restricted to your income. So that is 44,427. So your capital gain, long-term capital gain. Your long-term capital gain will be nil. So there will be no capital gain because you have already entire thing is being sold. So it is restricted to 2 lakhs. So we have to write that also as a note. So your note number is what? 1. You can write this as a note. So you will say that 54 EC will get restricted to whatever is being spent, whatever is being invested in the bond or your capital gain, whichever is lower. So that's what it is about. So your long-term capital gain is nil. Clear? So that is question number 10. Clear? So that's about question 10. So we'll solve one more question before this end of the session. A with his friend B started a partnership firm to run the business of dealing in shares. Okay. So A is now entering into this business of partnership with which he is basically, it is entered on 1st May 2022. So the business itself is 1st May 2022. A contributed 10,000 in cash. A contributed 10,000 in cash as capital, whereas B contributed some listed shares in company, which are held by him as investments. The cost of these to B in 2001 was 4,25,000, while their market value on 1st May 2020 was 13 lakhs. So the cost is 4,25,000. What is fair market value is 30, and what is credited to the books of account is 14 lakhs. In the course of the business during the year 2022-23, 50% of these shares were sold for 50,000, and STT was paid 50,000, or 50 was paid by the firm. So what is happening is, it is finally being sold, right? It is finally being sold, but it is sold by the firm because B has given it to the firm. B is finally giving it to the firm. Firm is finally selling it. So that's how you actually do it. So now what you do is, for this, the benefit is not available. Only when you are converting yourself as capital asset into stock in trade, it is taxed in the year of final sale by the stock in trade. But here, it is not final sale. He is giving it to the firm. So it's two different persons. So in B's hand, it will be taxed in the year of conversion itself, in the year of giving it to the firm itself. So what is actually happening? So as far as B is concerned, the sale consideration will be how much? Will be what is deposited in the books of account, what is credited. So B's capital is credited with 14 lakhs. So we'll have to ignore the market value and all. Whatever is credited in the books becomes the sale consideration for the partner. And that will be considered as a cost in the books of account. So there is no loss. So sale consideration is 14 lakhs for B. So these are listed shares. Which is there. But what does it say is, now it is not sold using listed stock exchange. It is only transferred. So there is no transfer in accordance with the stock exchange, recognized stock exchange. So conversion to the firm will not attract 112A, So conversion by the partner to the firm is not covered under this. So what will get covered will be finally treated as index cost of acquisition, because it will only get covered under 112 and not 112A. So what is his cost? His cost was 4,25,000. So 4,25,000. So 4,25,000 divided by 100 into 331. So what will be there? 4,25,000 into 331. That is 14,06,750. So you'll make a loss of 6,750. So it will be a long-term capital loss, because he purchased in 2001-2 and he is finally selling it in 2022-23. So this whatever conversion that is happening is actually giving it to the business on 2020 in 13 lakhs. So whatever is doing, we have to do it only till the year in which it's finally solding, right? So I'll just do one thing. This is not 331. We also need the indexation of 2021, which is 301. So 2021 is 301. So 4,25,000 divided by 100 into 301. It is 12,79,250. So basically, it is sold for how much? 50% of these shares were sold. So 4,25,000. It was agreed to credit. Market value is 14 lakhs. 50% of these shares were sold for 50. So whatever he sold is 14 lakhs. Index cost of acquisition is 4,25,000 divided by 100 into 301. That is 12,79,250. So the long-term capital gain will be 14 lakhs minus 12,79,250. That is 1,20,750. 1,20,750 will be your long-term capital gain, because we need to index it only till the time he is actually transferring to the firm. So that's why this 301 come into picture. But for the firm's perspective, it's a business sale. How much is sold? 50% is sold. 50% of these shares are sold for 50,000. Correct? 50,000 is what the final sales made. So now whatever they are selling, the business sale is only for the part in which it is sold for whatever purpose it is about. So if it's selling for 50,000, the sale value is 50,000. If he's selling for whatever number it is there. So now 50% of these shares were sold for 50,000 and STT was paid. We'll keep this as not 50,000. We'll keep this as 5 lakhs. Okay. So the sale was actually for 5 lakhs. Cost is basically 50% is only sold. So the cost itself is 7 lakhs. And STT STT is actually 50 was paid by the firm. So we can reduce 50. So finally, there will be a loss of 250,000. 250,000 will be the loss. So total loss to that will be 250,000 for this particular sale. So that's what it is about. So the cost, whatever is there, is 50%. This also will keep it as 100. So 50% of STT is 50. So 750,000, 200,050 is the total loss. So what we are doing is, in the hands of partner, we are calculating whole 100% because it is only sold to the firm. So it is not like conversion, not like earlier problem. We only treated 50%, not like that, because here it is full sale. The entire thing is sold. So 100%, it will be considered as sale only, not like conversion. So it is recognized in the year of thing that will be considered in the previous year, 2021. So it will be recognized in this year. It will be recognized in this year and not the year of final sale. And as far as the firm is concerned, it will be for AY 23-24, it will be treated as a loss. So that's what it is about. So with this, this will give you whatever is capital gain for B, what is the profit and business or profession for the firm. So that is the end of question 10. Kavita, 54 EC, how did it come? This amount, is it? See, this amount, question says he has invested 2 lakhs in bond. So now the capital gain is 44,427. So what is eligible? Eligible is 44,427. So because 54 EC or any exemption for that matter is restricted to your total of capital gain, it cannot go beyond that. What is STT? It is security transaction tax. We have covered like couple of classes earlier. Maybe you can go through that. What is the role of FMV in indexation? FMV in indexation is considered because when there is the value of some, like in that question, we are talking about this XYZ, brother, right? So if you actually see in this question, it is 15th June is converted into this. So whatever is there, whose number is this? Here, it is being given to father. It is being given to father for 4 lakhs. 4 lakhs. What are we talking about here? This is question of, okay, Mr. R. See, on 18th January 2000, he has purchased it for 1,76,000 plus 2,000. So we have not taken any fair market value here. The role of fair market value in indexation will only happen when you are considering 2001's fair market value. When your fair market value is that of 1st April 2001, then of course you need to index the fair market value. Otherwise, the cost of acquisition only will be indexed. Pranav, 50% is there. See, in this question, for B, we will take 100% because B is not converting. B is selling it to the firm. So that is why 100% is considered for B. But whereas for firm, only 50%. If you see the 7 lakhs, 7 lakh is 50% and not 100%. The entire 50% is sold for 5 lakhs. That's why we have taken sale consideration as 5 lakh. Shivlani, why is STT deducted? Security transaction tax is an eligible expenditure under PGBP. Security transaction tax. STT, PGBP, capital gain. STT is an eligible expenditure under PGBP, eligible expenditure. But in capital gain, it is not an eligible expenditure. That is why while computing firms thing, we are deducting STT, because for PGBP, it is an eligible expenditure. So security transaction tax, if you are computing for a PGBP, it must be deducted. If you're computing for capital gain, it is not deductible. So that's what it is about. So are there any more questions? Otherwise, I think we'll wind up. There are 4 more questions. Considering the time, I'll not continue. I'll stop it. Anyways, while uploading, I'll have all these 4 questions uploaded to it, so you can go through it. You can go through it and try computing it. And probably in the next class, we can also discuss if there are any specific questions on that. So, as we said, we have covered various questions from the exam perspective. So, I think all of you right now will have a complete understanding on capital gain. Please practice more questions. Take your suggested answer. Take your previous year's questions. Keep working on. The more you work is when you get more efficient. Capital gain for sure will at least have like 10 marks or so in your examination. So, please make sure you are giving full importance. So that is at least 5 to 10 marks of capital gain question. You need to give importance to solve it out. So please work out more problems on capital gain to get a complete grip on exemptions and this indexation and other concepts. So thank you for the wonderful session. We'll wind up with this.